Forex education. 1. Why trade Forex? Trading in Forex. Also known as the foreign exchange market, Forex is the market where one currency is traded against another. Some of the market participants exchange foreign currency for their own, like multinational corporations, which must pay wages and other expenses in different nations they sell products in. However, a large part of this market is simply currency traders, who make money or movements in exchange rates, just like stock traders speculate the price changes for stocks. So why trade Forex? The Forex market is by far the biggest and most popular financial market in the world. Traded globally by a large number of individuals and organizations, its average daily trading volume exceeds $5 trillion. It's a 24-hour market. It is open from Monday morning in Australia until Friday afternoon in the USA, which means you can trade morning, noon, or night. There are no commission fees, no exchange fees, no government fees and no brokerage fees. Most Forex brokers earn money from spread, which is the difference between a bid rate and an ask rate. No middleman. There are no middlemen between the trader and broker. Therefore the trader is at liberty to trade online without having to go through a central exchange, saving time and additional fees. Leverage gives traders the power to control much larger total contract value than their initial deposit. Generally, traders get to trade for as much as 500 times their leverage, so if you want to have an exposure of $12,000, you would have to deposit only $25, which makes it altogether a great platform. Free practice. Most online Forex brokers offer free demo accounts for you to build your skills and practice trading, along with real-time Forex news and charting services. This way, you can get a feel for trading without risking any money. Reasons not to trade Forex. Well, really, there is no reason not to give it a try. I used to think that you had to be some kind of genius or nerdy guy with a degree in economics to be a successful trader, but I soon learned this is not the case. I believe everyone can do it. And with a little patience you will be able to do it too. 2. When to trade Forex. The right time to trade in Forex. Although it's true that the Forex market is open round the clock, it doesn't mean that you should be trading every single minute of the day. Trading in Forex. Forex trading can be classified into 3 main trading sessions. First of them is the Asian trading session. From 12 a.m. to 8 a.m. usually in the session, exchange rates tend to range a lot, having short-term fluctuations resulting in breakouts later in the day. Here, you will notice pairwise trading such $/yen, euro/yen. At 7 a.m. the European session starts. Because about 30% of all Forex transactions come from London, you can see a lot of movement in most of the currency pairs. Volatility then quietens down in the middle of the session, at around 12 p.m. when traders are taking a break and waiting for the New York session to start. Just when the European traders are getting back from their lunch, US traders start coming into their offices. As the first half of the US session overlaps with the European session, you will notice that the market has the most liquidity at this time. At around 5 p.m. you can often see rates start to race as the London traders close their positions to avoid any overnight surprises. Then, after 5 p.m., the market quietens down until the Asian section opens again. 3. Trading terminology or where am I going long? Trading terminology or where am I going long? Sometimes it can seem that the traders have their own language. They use words that probably make no sense to a non-trader. For example, imagine you hear a conversation like this: I'm going short on cable but I am also watching guppy. How about you? Well, I'm currently flat, but I'm looking to go long on channel. What these traders actually meant was, I'm selling pound/dollar and looking for trade opportunities pound/yen. How about you? Well, I currently don't have any positions open but I am looking for an opportunity to buy euro/pound. So, here is a guide to some of the most common Forex slang words. Going long, placing a trade which is going to profit if the exchange rate rises. Going short, placing a trade which is going to profit if the exchange rate falls. Being flat, being neither long nor short. Having positions open in the market. Aussie, Australian dollar. Kiwi, New Zealand dollar, loonie, Canadian dollar, greenback or buck, US dollar. Swissy, Swiss franc. Cable, pound/dollar, fiber, euro/dollar, yuppie, euro/yen, guppy, pound/yen, channel, euro/pound. 4. How to trade with leverage. How to trade with leverage. If you were to trade in small quantities, for example €1 at a time, you would never make any profit. That's why, in the Forex market, currencies come in lots. 1,000 units form one micro lot, 10,000 units will form one mini lot and 100,000 units will form one standard lot. Right now you are probably thinking, I don't have that kind of money. Does that mean I should not be trading? This is where leverage comes in. Forex brokers offer up to 500 to 1 leverage. It means that to open a 1 standard lot large position you need only to have about $300 in your account. Let us take a look at this example. Exchange rate for the euro/dollar is 1.06880. You have your margin set at 0.2%. You decide to buy one standard lot, so you are buying 100.000 euros, which is worth $106,880. As your current margin is 0.2%, your broker sets aside $213 from your account. While this is considered to be a down payment, you will have to borrow the rest of the money to open a position. Of course, after you close your position, the money is returned to you along with your profit or your loss for this particular trade. Just remember, high leverage means you are susceptible to large losses as well as gains. 5. What's a pip? What is a pip? A pip is the exchange rate for a currency pair or a measurement of change. For currency pairs, displayed as decimals, 1 bit is equal to 0.00001. The exception here is the yen-based pairs, which are quoted with only 2 decimal places. Nowadays some brokers offer fractional pips or pipettes to provide extra precision and are displayed as a 5th decimal place. How to calculate your pip value? The value change in the quote currency, divided by the exchange rate ratio, times the amount of units traded, is pip value. Let's take a look at this example. The exchange rate for EUR/USD is 1.06910. You will have to divide the value change in quote currency 0.00001 by the exchange rate 1.06910, times the unit of amounts traded. If it is a mini lot which has 10,000, the value would be 0.094. To convert this to your account currency, all you have to do is to multiply this with your currency's exchange rate. So if you are living in USA, you have multiply 0.094 by 1.06910, which is 0.1 US dollars. 6. How to place a trade in Forex. How to place a trade in Forex. In Forex, you exchange one currency for another in the hope that the currency you bought will gain value against the currency you sold. In every single Forex transaction there are always 2 currencies involved. That's because you simultaneously buy one currency and sell another one. The first listed currency is called the base currency. The second listed currency is called the quote currency. The exchange rate tells you how much you had to pay in units of the quote currency to buy units of the base currency. For example, you would have to pay $1.06 to buy 1 euro. Or, you would get $1.06 if you sell 1 euro. There are 2 prices when you are trading in Forex goods. The first is the bid price at which the broker agrees to buy the base currency, in exchange for the quote currency. The price at which your broker plans to sell the base currency for the quote currency is known as the ask. The difference between these 2 prices is called the spread. So if you want to sell a euro, you will sell it at the bid price 1.06892, and if you want to buy a euro you will buy at the price 1.06902. 7 Types of Forex orders. Types of Forex orders. An order is an instruction from trader to broker that shows how the trader wants to enter or exit the market. Here are some of the most common tabs of orders. A market order is an order to buy or sell immediately at the best available price. This type of order guarantees that the order will be executed. Just remember that in a fast-moving market, price paid or received may be quite different from the last price quoted before the order was entered. A limit order is an order to buy or sell at a specific price. A buy limit is an order to buy at the limit price. This price will always be below current market price. Let's take a look at this example. The trader wants to buy EUR/USD, but he is only ready to buy if he can do it more cheaply. A sell limit is an order to sell at the limit price. This price will always be above the current market price. The trader wants to sell, but only if he can sell at price higher than the market price. A stop loss order is an order to buy or sell once the price reaches a specified price. It's designed to prevent additional losses if the pricing goes against you. It is the most important order of all. Consider that you have purchased EUR/USD at 1.06902 and you realize that you made a wrong move, which is a common case. When the prices start to fall, you place a stop loss order at 1.06700, and when the price touches this value, your broker will close the position automatically, which contains your loss to 202 pips. If you had not set your stop loss, the price could have continued falling until you lost all the money. You wouldn't want that, right? So, always use your stop loss orders. 8 Technical analysis in Forex. Technical analysis. The theory for technical analysis is based on the presumption that you can forecast future price movements by studying historic market data. As it is believed that all current market information is reflected in price, you can assume that all you need to make a trade is price action. Technical analysts study charts to look for patterns and believe that in similar situations pricing will act the same way as before. For example, if a price had bounced several times previously, a technical analyst would think it will also do the same the next time the price reaches this level, and so he sets his sell orders here. The more traders that look for certain price levels and patterns, the higher the probability that these patterns will play out the way they think. Why is that? Because technical analysis is based on psychology. A chart is nothing more than a picture of human emotions. The market moves because of two primal emotions, greed and fear, which, in effect, compels humans to repeat past triumphs and mistakes. Remember, technical analysis is very subjective. Just because you see a pattern on the charts, that doesn't mean the rest of the traders will interpret it in the same way. 9. Fundamental analysis in Forex. When a forecast is made of the future price movement based on the overall state of economy and taking into account various factors such as interest rates, employment, housing, production, and manufacturing, it is known as fundamental analysis. Fundamental analysts believe that the market may misprice currency in the short run but that eventually, the correct price will be reached. They may set out to profit by purchasing a mispriced currency and then wait for the market to recognize its mistake, at which point, they reprice the currency. In theory, if a country's future economic outlook is good, its currency should get stronger. So why is that? If a country's economy is improving, there may be a need to raise interest rates, control growth and inflation. Higher interest rates can attract foreign investors looking to buy the country's financial assets. In order to do that, they first need to purchase this country's currency, and higher demand means higher prices. So the value of this currency increases. Let's take a look at this very recent example. In August 2013, the exchange rate for pound/dollar was around 1.53. The Bank of England indicated that because of the unsustainable inflation levels, it might need to increase interest rates in 2015. Only 8 months later, the exchange rate had rocketed to 1.7, a head-spinning increase of 17,000 pips. 10. Types of Forex charts. Types of Forex charts. In today's lesson we are going to look at the most popular charts. When there's a simple line that connects the open, low, high and closing price, it is known as a line chart. This chart will look clean and there will not be any market noise captured in this chart, giving a clear indication of the resistance and support levels. Bar charts show us the opening, closing, low and high prices for each given section. The horizontal line on the left shows the opening price. The bottom of the vertical line shows the lowest price at a specific time period. The top of this line shows the highest price at a specific time period. The horizontal line on the right shows the closing price. This is the most popular type of chart. In most trading literature you will find charts displayed exactly like this. Candlestick charts display the same information as bar charts, but the visual representation is a lot better. The big blocks are called real bodies. On top of the vertical lines of the block, you will notice the upper shadows, and the lines that are under it are known as lower shadows. Usually, if the real body is in a lighter color, the currency closed above its opening price. But if the real body is in a darker color, currency closed lower than it opened. Don't worry about the colors for now, because in most trading platforms, you can easily customize them as you like. The main advantage over any other charts is the excellent visual representation that the candlestick provides. It shows clearly who is in control, bulls or bears. I can't say any of the charts are better than others, but I would advise beginners to stick with candles for now. 11. Support and resistance in Forex. Support and resistance. Support and resistance are two of the most popular concepts of technical analysis. These levels are prices at which there is a barrier where the price would either stop or reverse at the given level. Support is a level that prevents prices from being pushed downwards. Resistance is the level that prevents prices from being pushed upwards. There are 3 golden rules for support and resistances. The longer the price stays at the support or resistance level, the stronger it gets. This happens because the more obvious the level becomes, the more traders will be placing their buy or sell orders there. When a support or a resistance level breaks, the stronger it has been, and the stronger the next move will be. In theory, every support should become resistance and every resistance should become support. Here you can see the price was rising and met resistance. When it broke through, it was the same level from the upside and it became the new support. The same can be seen in downtrend. Price was falling and it met support. It managed to break through and tested this level as the new resistance. 12. Trend lines. Trend lines. Support and resistance lines can be not only horizontal but also diagonal. Diagonal support and resistance lines are called trend lines, and they are drawn by connecting 2 or more price peaks or bottoms. Trend following is one of the most basic and profitable trading strategies. Let me explain how that works. If a currency pair is in an uptrend, traders wait for the price to approach its trend line, and if it acts as a support, they buy once the price bounces beyond that level. Conversely, if the price is trending down, traders wait for it to approach its trend line as the resistance, and sell after it bounces. Remember, the more times support and resistance levels have been tested, the stronger they get. The same goes for the trend lines as well. The biggest problem with trend lines is that unlike horizontal support or resistance, they can be very subjective. Tell 5 different people to draw a trend line, and you will get 5 different trend lines. A trend channel is another great tool for a trend trader. In order to make a channel, All you have to do is draw a line parallel to your trend line. Channels are great for setting your price target. Let's take a look at this example. You just went long after the price bounced from a rising trend line, but you didn't know where to take profit. By drawing a channel, you can project how high the price is going to rise, and based on it, you can calculate your target profit. Great stuff, huh?